I track about 90 economic indicators every month, not to sound smart, because my clients are making million-dollar decisions and they deserve someone who actually does the homework. Here's what the data says about Southern California real estate right now. Mortgage rates just hit 6.30%. That's a 4-week low and a full half point below where they were this time last year. On a $700,000 loan, that's roughly $350 less per month. Real money, but rates alone don't tell the whole story. San Diego County pending sales dropped 2% in the past 2 weeks. Inventory climbed to over 5,000 active listings. Expected market time rose to 80 days. And for luxury homes above $2 million, expected market time jumped from 116 to 136 days in just 2 weeks. The spring market may have already peaked. Now here's what I'm watching over the next 90 days. The Iran ceasefire expires this week. If it holds and a real deal materializes, oil drops to the low 80s, mortgage rates could test below 6% by summer, and sideline buyers come back fast. If it collapses, rates stay stuck and gas stays near $6 a gallon in California. I put the odds of a real deal at about 25%. May 8 brings the jobs report. I'm not watching for mass layoffs. I'm watching for quiet attrition, companies not replacing people when they leave. That slow bleed is already showing up in tech hiring data, and it hits housing demand about 60 to 90 days later. And May 18 brings the first wartime treasury data. If foreign governments are pulling back from buying U.S. debt, mortgage rates stay high regardless of what the Fed does. That's the scenario where waiting for rates to drop stops being a reliable strategy. Now let's talk about what this means depending on where you own. If you're in Rancho Santa Fe, Del Mar, La Jolla, Encinitas, Newport Beach, or Laguna Beach, your market is insulated. These zip codes run on cash buyers and global capital. When macro uncertainty rises, premium coastal real estate actually becomes more attractive to the people buying in your price range. Inventory stays tight. Accurately priced homes still generate competition. Year over year, luxury inventory in San Diego is actually down 12%. Hold your position. If you're in Carmel Valley, Forest Ranch, Irvine, or Mission Viejo, you're in a holding pattern. Buyers are present but hesitant. The detached home market in San Diego is sitting at 75 days expected market time right now. That means sellers who price correctly are still moving properties. Sellers who test the market are sitting. Every week on market costs you negotiating leverage. And that's not an opinion, it's math. If you're in Temecula, Murrieta, Menifee, or anywhere in the Inland Empire commuter belt, this is where I want you to pay closest attention. A 50-mile commute at $6 a gallon adds real dollars to monthly household costs. Inventory is building in these markets. If you've been thinking about selling and you have a legitimate reason to move, the next 60 days may be a better window than you'll get later in the summer before inventory peaks further. Here's what I want you to take away from all of this. This is not 2008. Homeowner equity is at record highs. Foreclosures in San Diego County are just 1.3% of all listings. March sales closed at exactly 100% of asking price, meaning 99.4% of sellers closed with equity. The structural foundation is solid. But this is a market where being informed beats being optimistic. The next 90 days will tell us whether the second half of 2026 is a relief rally or a continued grind. I'm Ray Stendall with Stendall Realty Group, serving San Diego and North County for over 20 years. Full breakdown with zone-by-zone guidance is linked below. And if you want to know exactly where your home stands in this environment, send me a message. That's what I do.